Thank you. I'm so delighted that I now know this word miserableism, because I think having to follow a speaker like that on a similar topic is its own form of personal miserableism. The good news is we actually agree on a lot of things that were just discussed. The good news for you, I was an English major, so no slides. So I'd like to start out talking about where we are, and again, after that presentation, you may physically sort of wonder where you are, the reason I bring it up is for very similar reasons that our previous speaker talked about, which is this, we call it a wall of worry, he calls it miserableism, is all the news cycle is just overwhelming and increasingly negative. But fundamentally, things are very good. When I go back to thinking about it and sort of putting it in a narrative, I go back to 2016. And the two major events in our view that sort of sparked change then. First was Brexit, a vote that nobody thought was going to go the way it did. It now may be undone. We'll know. I'm not clear. It's not clear to me that even Theresa May knows how this is going to end up. And then the second was the U.S. presidential election. And we trace these things back to, if you will, sort of the, even though it would have, I think, been 2006, 23, sort of the teenage rebellion of NAFTA and sort of the forces of globalism that began and were codified in NAFTA that really left a lot of people behind, that changed a lot of industries, not just in the U.S., but around the world, and also affected a lot of not just economic policies, but political outcomes, as well as, to some degree, migration. I think in the UK, our view was that was to some degree economic, also security-oriented. Here in the US, I do think, and we do think as a bank, it really was a recognition in 2016 of parts of the economy that had been left behind and had sort of been out of work for a long time. I think those were described in the press typically as sort of the the white male Midwestern former factory worker who was now an opioid addict, which is obviously a bit of an exaggeration, but I think sort of the general construct of that resonated very strongly. And certainly, as our previous speaker pointed out, there was a lot of strong rhetoric about that on that side and now on both sides. The good news is that those parts of the economy really have, as we just heard about in much more detail than I'm going to go into, really have responded and done well. You may remember going into the 2016 election, many people, including us, thought that one, Hillary Clinton would win, and two, if for some reason Donald Trump would win because of the policies he was espousing, that the markets would sell off dramatically and the economy would go in the tank. That did not happen. In fact, the exact opposite happened. Why is that? Well, in our view, it really boiled down to sort of three things. One, the tax cut stimulus that we've got, check that box. It took till late 2017. The second, infrastructure spending, yet to see if any of that happens. And then the third, deregulation. And while we haven't had formal deregulation, you have seen on the margins, in my view, very important sort of lacks of enforcement about this. We were just hearing about mortgages. The head of HUD said last year, when we come to mortgage fraud, maybe we don't need to punish the banks for things where they don't dot the I's or cross the T's, but fraud is something we should persecute. Well, what we read that is and we are a bank, is that there is a sort of a more open understanding of the effects of these policies and also how to enforce them. And what that probably means is a little bit of taking the foot off the brake in those areas. So where we are, in our view, is very similar to our previous speaker said. We think the GDP that we could see in this year is 2 to 2.5% in the U.S. We think globally we could get to 3 to 3.5%. Last year was a bit higher in the U.S. Our view, where we differ a little bit from the previous speaker, is we don't think all of the sugar high or the benefit from the tax cut actually has been filtered through. And in particular, buybacks have not ended. I know that buybacks have gotten some negative press recently, but I would point out that last year was a record year in terms of buybacks, and the estimates that we're seeing for this year are for potentially even higher amounts. That's more market than economic, but I think it's an important indicator of corporate optimism. And the other thing that continues and really did start, in our view, after 2016 was a dramatic increase in animal spirits and really optimism, corporate optimism, and not just in big companies, but probably more importantly in smaller companies. Why is that more important? Well, as you may know, what really drives employment in this country has historically been small and medium-sized companies. Those are the engines of growth and also often the engines of innovation. And I think for very long after the last recession, there was a feeling among those companies, understandably so, that they were more heavily regulated. And if you just think about it very simply, as I do, regulation's expensive. I think, we have a lot of business owners in this room. If you are a large corporation, you have a lot of revenue to spread that over. You can afford the legal fees, the same legal fees. A lawyer who's $500 an hour is $500 an hour regardless of how much you can pay. But if you have a smaller fee, if you have a smaller base of revenues to spread that over, then that makes it a lot harder for you to sort of go do other things like invest in your business, hire more people, et cetera. So that's another reason that we remain very optimistic about the business cycle and it continuing. In terms of what's likely to drive it, in our view, one is most likely is the consumer. This continued consumer optimism we just heard about. The consumer is anywhere between 2/3 to 70% of the U.S. economy. Which is, when you think about it, sort of, people talk about the amazing, sort of aspect of Chinese consumerism and what's going on there, which is an amazing transition. But the size of the U.S. consumer economy is larger than the entire economy of China, just to put it in perspective. So really, as goes the U.S. consumer, largely goes global U.S. GDP and also global GDP. In terms of that global GDP number, the reason that we remain very optimistic on that was that not only that the fundamentals remain strong here, but that the two sort of main impediments to that were things that could be fixed by policy. One is the China trade dispute. That seems to be resolving itself. Our view is that there is political reasons on both sides to solve it. In this country, we're now firmly in the 2020 presidential re-election cycle. And historically, presidents running for re-election have done everything they can to reignite the economy and make sure that's not an impediment to their re-election. And you don't have to go back any further than the previous administration. When President Obama was going into the 2010 midterm elections, he was campaigning to get rid of the George W. Bush tax cuts that were going to roll off at the end of that year. And when he had his hat handed to him in the midterms, he could have just let them run off, but he quickly not only extended them, he added a payroll deduction because he understood that that was important to the economy and that would be important to growth going forward. For that reason, I think that this administration, despite all the rhetoric that we hear, is very incented to get some sort of deal with China. Whether or not it's going to fix long-term issues like intellectual property theft and forced technology transfers, I don't know. But I do think it'll probably be some sort of something that will calm the markets and sort of calm investor sentiment. The second is the Fed. And we have been saying for a while now that actually the biggest threat to this economic expansion is not been some geopolitical event, is not political problems, is not policy issues around trade. It's actually central bank policy and a potential for an error. And frankly, that's what we saw last year in our view. As our previous speaker talked about, Jerome Powell made the mistake of continuing to raise rates last year. In our view, there's a couple of things that need to be taken into perspective. One, it was his rookie year. And Ben Bernanke, in his book after he retired from the Fed, described being the Fed chief as 2% economics and 98% communication. And I think Powell had a very painful lesson last year in that regards. One could argue he was painted into a corner a little bit in terms of the December rate hike by the president, but that's sort of neither here nor there. The other thing was that what our previous speaker talked about was inflation. Now, usually when you get to such low levels of unemployment, you start to really worry about wage inflation, which we have not seen. Or we haven't seen to a point where it's been problematic. And we haven't seen inflation overall really pick back up. So I believe the number is now 10 years that the Fed has not hit its 2% inflation target. That's probably going to continue for 2019 in our view. The other major thing that was going on in the background that we don't think has gotten enough press was the fact that through the end of 2018, over a 2-year period, we had 9 rate hikes, so about 2.25%. At the same time, the Fed's balance sheet was letting stuff roll off, had planned. As a reminder, the Fed's balance sheet was below $1 trillion going into the last recession, but in order to enact quantitative easing and help the economy and inject liquidity into the system, the balance sheet swole up to about $4.5 trillion. It's now about 4.1. Nobody knows exactly what the right number should be, but they've been letting stuff roll off. But long story short, the effect of that over the same period when they raised rates 2.25% was the equivalent of sort of a shadow raise, in our view, of another 200 to 300 basis points. So instead of just the 2.25, it was more of 4.25 to 5.25. And that's really, in our view, what the market was reacting to. And that was the lesson learned. At the end of the year, we do a lot of tax loss harvesting for clients, which means we're doing a lot of trading towards the end of the year to recognize losses in client portfolios. And usually by the end of the week before Christmas, it's pretty quiet and volumes died down and people can go on vacation. That was not the case this year. The only sort of silver lining I could say to my team as we had to come back in and deal with that every day was that by Christmas Eve, they still had a better Christmas than Chairman Powell, and we sort of view that as that's when he came out and said that they would be data dependent, essentially that they were going to ease and be more accommodative. And it was an interesting story to see because in October 3rd of last year, Powell had come out and said that we were nowhere near neutral. So there was this, you can trace pretty much most of the market's reaction, most of the turmoil around that between the October 3rd date when he said that we were nowhere near neutral, meaning that we were likely to continue rates, and the December 24th capitulation, if you will. We're of the same view that that's likely to continue through 2019 and possibly actually through the 2020 presidential election cycle. We'll see about that, but the long story is we don't see a recession on the horizon either. Now, maybe this is when you should worry, when everybody's on the same side of the boat is when it tips over. But I think if we go back to fundamental reasons, we don't see any reason to have an economy. And I heard an amusing anecdote. Bernanke and the next Fed head were on a panel recently, and Bernanke was saying, usually what causes a recession to end is when the Fed shoots it in the face, by which they meant over tightening. So I think if you check that box, that makes you pretty comfortable. And I talked about the other one being the policy issues with China. So that makes us sort of more optimistic that what we're likely to see, not just in the markets, but in the economy, is a return to that optimism, and in probably what's most important, a return to spending by businesses, whether that's capital expenditures, employment where it can be done, and other investments in the business, and that's likely to continue driving that. Because the one thing that we're missing right now was talked about earlier, is employees. And so the only way you continue to grow is to add productivity, and the only way to increase productivity, in our view, is to invest in businesses. So whether that's capital expenditures, hard capital expenditures, like a lot of what you see in Kern County, whether it's investments in technology to increase sales, or retraining employees to do more with less, so to speak. You're going to see a combination of that in our view, and we think we're going to see that pick up. And we think the fact that we're getting some sort of visibility on the China deal coming together here means that, and you're starting to see this discussion, you're starting, corporations are going to increase that spending. So where are we going? Well, this is a little more long term. I've talked about the economy, both here domestically and globally. If I go around the rest of the world, there are pockets of concern for us. Certainly Europe is a concern. European parliamentary elections are coming up later this month and in April. we expect to see more nationalism and probably more dispute within the trading bloc. We don't necessarily see anybody else joining Britain leaving, but it's going to be harder to govern. And then we also see big financial issues, particularly with their banks. Their banks did not clean up the way U.S. banks. You may have seen recently German banks have been in the news about possibly enduring a forced merger because they never did a good bank, bad bank. They still have a lot of bad debt on their balance sheets. When we look at Japan, Japan is actually in a good place in our view. Yes, it suffered a little bit from the U.S.'s China trade policies, but Japan has done everything they can to achieve stopping deflation and stopping the shrinking economy and being able to at least sort of moderate that policy. So we're optimistic on that. And then when we look at the underlying fundamentals for China, we still think they're good. We still think once they sort of come through this trade issue, getting to sort of a 6-7% GDP growth will continue. And that leads me to the other reason, the other political reason on the Chinese side that we think is getting them to the table. One, certainly the trade policies with us, the tariff issues, hit them harder than it hit us. But, that makes sense. They export 4 times as much to us as we export to them. But the other is that their economy has transitioned dramatically. And the way I think about it in a very simple terms is they've gone through an amazing experiment the last 40 years where they basically transitioned what took developed countries in the West a couple hundred years from an agrarian lifestyle 50 years ago to an industrial, and are now trying to change that into a 21st century, more consumer-driven economy. And they've made a lot of changes there. But if that conveyor belt breaks down, then what happens is that there's potential for political disruption. So there's a big incentive for Xi, even though he's premier for life, to get to that. So let me pivot a little bit to what we're really see as the underlying growth tenets going forward and how that applies to Kern County. Some of the areas, when I look at the Kern County Economic Development Board's areas of focus, make a lot of sense to us. Energy. We just heard about the fact that the U.S. is now the swing producer. We now can produce more than Saudi Arabia. The fact that the price differential between shale and what's in Kern may not be good for Kern in the short term. I do think what's good probably for the oil patch in the short term is that oil seems to have come out of its recession and stabilized, in our view, sort of at $50 to $60 a barrel. When we look further, there's probably a huge potential that didn't get enough notice 2 years ago. Is the fact that the U.S. is now allowing the export of oil and gas to other countries. Kern County, with its location and its pipelines to Los Angeles, the refineries there, as well as the Port of Los Angeles, if you want to think about potential growth opportunities over the next 10, 20 years, that in my mind is a very obvious one. Also, liquefied natural gas. Now, there have been issues, environmental issues with both of those, sort of holding up on the, putting up facilities for that in a port on the west. But this administration has come out and said, maybe we will use military bases for those offloading bases. Transportation and logistics. The last 2 years, we've heard a lot about the Amazon effects and the death of retail. But despite all of that, online commerce still only accounts for about 20% of U.S. commerce. That, in my mind, means there's a lot of room to grow. And what Kern County has done in being forward-thinking and getting logistic hub here makes a tremendous amount of sense. Allentown, Pennsylvania is another example of this. Allentown, somewhat like I think the warehouse property here, has gotten very expensive. And the reason is for Allentown is about is within a 24-hour truck drive, for about 60% of the U.S. population. So when you sort of think of where Kern County is located for southern Central California on a slightly smaller basis, that is a tremendous location for that. And I think that's going to continue to grow. You also think about the fact that politically, I think Kern County seems to be taking steps in a state that can be less than constructive for businesses to attract business and make it easier to get done. And I would actually say there's a silver lining in the fact that unemployment is higher in Kern County than it is nationally, which is that labor is still very affordable here. And you're probably going to see less disputes about the affordability in wages in places like you've seen like New York City and Los Angeles. I think that's going to continue to attract business and will probably feed it. So going back to that 20%, if you look at countries like China, that number is more like 40, 50%. You may say, well, yeah, but they don't have the infrastructure we do. I think what that really tells you, though, is that there's a lot of room for that electronic commerce to grow, and that's what we're going to see going forward. Aerospace and defense. Despite all the bad news that we've seen out there about Boeing in the terrible incident that happened in Africa, the reality is that the U.S. aerospace complex is still the best in the world. With all the turn towards nationalism in Europe, in Asia, and even in this country, in pulling back from alliances, the demand for aerospace and defense products, things like missile shields, connected networks, is going to remain. And having exposure to that here in Kern County is going to continue, in our view, to be very strong. Healthcare services. I think this is one I can't emphasize enough, and it's twofold. One, affordability, which we just heard about, really is in Kern County's favor. And you think about the retirement of baby boomers, which is the largest cohort of the U.S. population. It's in the number of it's averaging about 10,000 people a day. And as people move to situations where they're living off of fixed income and they're in an area possibly like Los Angeles or Orange County, where their real estate is extremely valuable, they're thinking of downsizing, and they may be thinking of moving to a place where there's A, higher affordability, and B, the availability of healthcare services. And I don't mean just acute services like we heard out at the beginning of this day, as important as those are. I'm talking more about people helping at home, medication, things like that, things that are real employment drivers. And I think that's going to continue to drive things in Kern County. And then agriculture. Certainly the lifting of the Chinese tariffs will help agriculture overall. It may not help as much immediately with some of the things that are the biggest exports from Kern County, like almonds, grapes, and citrus. However, I would argue that the demand for almonds in particular and fresh produce in general is going to continue to grow in the U.S., and you don't have to look any further than what happened with Kraft Heinz, is a realization by the markets of that change in demand in the marketplace away from produced goods to fresh goods. And you think about almonds as sort of a low-fat alternative protein, it's a very attractive place. So if I think about all the things that we are constructive about in terms of our view of the U.S. economy, and that is continued employment growth, continued the start of some wage growth, but continued general sort of affordability of the labor force. Areas of focus like energy, like agriculture, like healthcare services, like aerospace and defense. Kern County has actually, over the last 10 or 15 years, really set itself up to participate in those areas. Perhaps unknowingly, perhaps you guys saw the future better than others of us did, but to participate from what's likely to drive the U.S. economy, regardless of the political atmosphere, over the next 10 or 20 years, in our view. So I think with that, it looks like my time is up, but I'll see if there are any questions. Well, I didn't see anybody fall asleep, so I'll thank you for that. All right.